In a single month, silver lost nearly a quarter of its value. The headlines were loud, the explanation was simple: the Fed, the dollar, the rising rates. Everyone agreed. Everyone moved on. But beneath that clean, comfortable story, something was quietly breaking. A shift so deep, so structural, that it could make the entire Fed narrative completely irrelevant by the end of this year. Almost no analyst mentioned it. Not one major desk warned about it, and the few who noticed stayed silent because what they found did not fit the story they were telling. So the question is not why silver fell. The real question is, what is hiding underneath the fall? And why are the people who know saying nothing? Welcome back to John Egg, the place where the world's biggest money stories get explained the way they actually are, not the way the headlines pretend they are. Now, before we go any further, do an old friend a small favor. If this channel has ever helped you see the market a little more clearly, reach over, find that subscribe button, and press it the way you'd lock the front door at night before sleeping, firmly, and without thinking twice. It costs nothing. It takes 1 second, and it keeps you in the room when these stories unfold. And one more thing, and this is something the team here is honestly curious about. Tell us in the comments, which city, which country are you watching from right now, and what time it is on your clock. Let's see just how far this conversation truly reaches. Now, let's begin. In the final days of June, silver did something it had not done in years. In a single month, it fell more than 22%. For a metal that millions of people trust to protect their savings, that is not a small dip. That is a collapse. It was silver's worst month since the early days of the 2020 panic, and for the first time in many months, the price slipped below a level that traders had defended for a long time. When something falls this hard, the world wants an answer fast. And Wall Street gave one. The answer was clean, simple, and easy to repeat. They said the central bank had turned aggressive. They said interest rates were going higher. They said the dollar was strong. And they said that when rates rise and the dollar climbs, a metal like silver, one that pays no interest, one that costs money just to store, has no reason to be held. On paper, this story makes perfect sense. It is logical. It is textbook. And for the most part, it is true. Silver pays no yield. It sits in a vault and does nothing. So when a person can earn a safe, rising return simply by holding government debt, the reason to hold a quiet metal weakens. As rates climbed and the dollar pushed toward its highest level in a year, fast money began to leave. Traders who had bought silver hoping for a quick rise rushed for the exit. Selling fed more selling. The price broke through one support level, then aimed at the next. The charts confirmed the damage. The trend turned down. Momentum stretched to the point of exhaustion. Every technical signal that traders watch flashed weakness. By every visible measure, silver looked like a falling knife that no careful investor should try to catch. And here is the important part. None of that was wrong. The people warning about the central bank were not lying. The dollar really was strong. Rates really were expected to rise. The fast money really was leaving. Anyone who looked only at these forces and decided to sell could not be called foolish. They were reading the visible evidence, and the visible evidence pointed down. This is exactly why the crash felt so settled. There was no argument. There was no debate. The story explained the fall. The fall matched the story, and the market simply moved on to the next headline. When everyone agrees, the mind relaxes. The case feels closed. But that comfort is precisely where the danger hides. Because a clean story is not always a complete story. A reason that explains why something fell does not always explain how far it should fall, or whether the fall makes sense at all once you look beneath the surface. The central bank explained the trigger. It explained the spark. It explained the panic of a single month. What it did not explain was the foundation underneath the entire silver market. And that foundation was already moving, slowly, silently, in a direction that very few people were watching. The crowd was staring at interest rates. They were staring at the dollar. They were staring at the screen, watching the price drop, nodding along to a story that required no further thought. And while every eye was fixed on that one bright, obvious explanation, something far quieter was unfolding in the background. In mines, in factories, in government offices on the other side of the world. It was not loud. It did not make headlines. It did not fit the simple tale that everyone had agreed to tell. But it was real, and it was building. A serious observer, watching all of this unfold, would notice something strange. The explanation everyone trusted was too neat. It answered the easy question and ignored the hard one. It described the weather of a single month while saying nothing about the season that was changing underneath. And in markets, the most expensive mistakes are never made by the people who are wrong. They are made by the people who are right, about only half the story. Every story has a moment where it begins to break. Not loudly, not all at once. Just a small detail that refuses to fit. A thread that once pulled slowly unravels the whole comfortable picture. For silver, that thread was hiding in plain sight. If the crash was truly about interest rates and a strong dollar, and only about that, then something simple should have happened. Gold should have fallen too. Gold is silver's older, calmer brother. It also pays no yield. It also costs money to store. It also suffers when rates rise and the dollar climbs. The two metals usually walk together, hand in hand, pushed by the same winds. So when the same hawkish central bank and the same powerful dollar pressed down on both of them, they should have fallen together. But they did not. Gold barely flinched. Silver collapsed. And that single fact quietly destroys the clean story everyone agreed upon. There is a number that experienced investors watch closely. It measures how many ounces of silver it takes to buy 1 ounce of gold. When this number rises, it means silver is losing ground against gold. When it rises sharply, it means something is wrong with silver specifically, not with metals in general. In just 1 month, that number jumped dramatically. It surged by an amount rarely seen in such a short window. Silver was not simply falling with the market, it was falling faster, harder, and alone. Now think carefully about what that means. If the cause were only the central bank and the dollar, gold and silver would have been wounded by the same blade. Instead, silver was bleeding from a second wound, a wound that gold did not share. Some force was pressing on silver, and silver only. A force the headlines had ignored because it did not fit neatly into the tidy tale of rising rates. So what was that hidden force? The answer lives in a place most people never connect to the price of silver, not in a trading room, not in a central bank, but on rooftops, in deserts, on the gleaming surface of solar panels stretched across the world. For more than a decade, the solar industry had been one of the hungriest buyers of silver on Earth. Every solar panel needs a thin layer of silver paste to carry electricity. As the world raced to build clean energy, factories swallowed silver by the millions of ounces. Solar became one of the metal's greatest engines of demand. It was the quiet hero behind silver's long climb. But heroes can turn, and this one was turning fast. The biggest panel makers in the world had a problem. Silver was expensive, their costs were rising, and no business in history has ever happily paid more for something when a cheaper path exists. So their engineers went hunting for a way to use less silver, or none at all, and they found it. A new kind of solar cell, one that replaces costly silver with cheaper metal, moved from the laboratory toward the factory floor. The largest manufacturers announced they were scaling it up. Mass production was no longer a distant dream. It was beginning. Right now. In real time. The effect on demand was immediate and brutal. Tens of millions of ounces of expected silver buying were quietly vanishing from the market. Not over 10 years, but in a single stretch. A buyer that everyone had counted on was shrinking before their eyes. Here, finally, was the second wound. Here was the force pressing on silver that gold never felt. Gold has no rival in solar panels, silver does, and that rival had just arrived. For a moment, this seems to confirm the bears. It seems to prove the sellers were right all along, that silver was simply a doomed metal, abandoned by its greatest customer, sinking under the weight of cheaper technology. And if the story ended there, the case would be closed for good. But the story does not end there. Because a careful observer would now ask a sharper question, the question almost no analyst bothered to ask aloud. Yes, demand was weakening. That was real. That was visible. That was loud. But what was happening on the other side of the equation? In the mines, in the ground, in the places where silver is actually pulled from the earth. What was happening to supply? That was where the truly dangerous secret was buried, and it pointed in the exact opposite direction of the panic. The crowd was watching demand. They saw the solar buyers shrinking, and they decided the case was closed. Silver was losing a customer, so silver must fall. Simple, obvious, final. But the crowd was only looking at one half of the scale. Every price on Earth is a balance between two forces, how much the world wants and how much the world has. The headlines had studied the first force in great detail. They had completely ignored the second. And the second force was telling a very different story. Here is the fact that almost no analyst put on the table. The supply of silver was not loose. It was not comfortable. It was not even stable. It was shrinking, quietly, steadily, and for reasons that had almost nothing to do with silver itself. To understand why, a person must understand something strange about how silver reaches the world. Most of it is never the main goal. The majority of silver pulled from the ground does not come from silver mines at all. It comes as a leftover, a byproduct, of mining other metals like lead, zinc, and copper. The miners go digging for those base metals, and silver simply comes up alongside them, almost by accident. Now follow what that means. If the world's silver depends on the mining of other metals, then the price of silver no longer controls its own supply. When those base metal mines slow down, when their ore grades fade, when their profits weaken, silver production falls with them. It falls even if silver itself is in desperate demand. The metal cannot simply order more of itself into existence. And the mines that do target silver directly? They are a small minority. Building a new one is brutally slow. It takes years of permits, years of digging, mountains of money, and the patience of a saint. So even when silver's price climbed, no flood of new supply arrived to meet it. The ground was simply not giving up more. The result was a deficit, not a guess, not a forecast built on hope. A real physical shortfall, where the world was using more silver than it was producing. And this was not a single bad year. It had happened year after year after year, stacking quietly on top of itself. For years now, humanity has consumed more silver than it has mined. Think about what that truly means. Every single year, the gap had to be filled from somewhere. So it was filled from old stockpiles, from melted down scrap, from vaults slowly being emptied. The world had been living off its savings, drawing down hidden reserves to cover the shortage again and again. But savings are not infinite. A vault that is emptied does not refill itself, and there comes a point where the easy silver is gone, and the only thing left to balance the books is a higher price. The bears never mentioned this. Their story had no room for it, and then came the twist that turned a slow problem into a sudden danger. On the other side of the world, the single largest source of silver flowing into global markets made a quiet move. A new rule appeared, one that, on paper, looked like simple paperwork. From now on, silver leaving that nation's borders would require special government permission to export. To a casual reader, it sounded like nothing, a small administrative formality. But to anyone who understood the game, it was a loaded weapon placed gently on the table, because that single rule handed one government the power to slow the world's silver supply whenever it wished, without ever announcing a ban, without ever inviting retaliation simply by choosing to approve fewer shipments. And that same nation had every reason to keep its silver at home, to feed its own enormous industries, to protect its own future. Why would a country send its silver abroad when it could keep it, starve the rest of the world, and let everyone else fight over what little remained? It wouldn't. And the moment that supply began to choke, the math that everyone trusted would quietly fall apart. The shrinking demand from solar, the very thing the bears were celebrating, was about to collide with a supply that was shrinking even faster. The market believed it was watching a metal that was dying. It was, in truth, watching a market being squeezed from both ends, and almost no one had noticed the trap closing. So now the full picture stands revealed, and it looks nothing like the simple story the headlines sold. On one side, demand was weakening. The solar buyers were pulling back, swapping silver for cheaper metal. That was real. On the other side, supply was weakening even harder, choked by struggling mines, by years of deficit, and by a single nation quietly tightening its grip on the world's flow of silver. That, too, was real. Two forces, both pressing inward, both shrinking at once. And here is where most people make their fatal mistake. They assume that if demand falls, the price must fall. But that is only true if supply stays still. When both sides shrink, the question is no longer whether the price drops. It is which side is shrinking faster. And every honest piece of evidence pointed to the same uncomfortable answer. The supply was tightening faster than the demand was fading. That changes everything, because a market where supply vanishes quicker than demand is not a dying market. It is a coiling spring. Now, fairness demands honesty. The bearish case is not foolish, and a serious mind does not dismiss it. The central bank really might raise rates again. The dollar really might stay strong. The fast money really might keep selling for weeks, even months. The solar substitution really is happening right now in real factories. In the short term, none of that has gone away. The price could fall further before anything changes. It could test lower levels. It could frighten everyone who still holds it. That part of the story stays true, but here's the difference between the careful observer and the panicking crowd. The crowd believes the falling price is the conclusion. The careful observer understands that the falling price is only the trigger, and that triggers are temporary, while structure is permanent. Fast money leaves, panic exhausts itself, sellers eventually run out of things to sell. But a physical shortage does not get bored, it does not change its mind, it does not move on to the next headline. It simply sits there, growing quietly, until the moment the world reaches for silver that is no longer easy to find. And when that moment arrives, the price does not ask permission. It does not wait for the central bank. It does not consult the dollar. It moves, because that is the only way a market with too little supply can force itself back into balance. Either the price rises high enough to scare buyers away, or it rises high enough to drag new silver out of the ground. There is no third path. This is not opinion. This is simply how a market with empty shelves behaves. So picture the trap that the simple story has set. A cautious investor reads the headlines. He sees the central bank. He sees the strong dollar. He sees the 22% crash. The story is clean, so he sells, convinced he is being wise. He congratulates himself for avoiding a falling knife. But he sold for half a reason. He answered the easy question, why did it fall? And never asked the hard one, what is happening underneath? He stepped out of the room exactly as the floor beneath the market was quietly being pulled away. If the physical shortage continues to bite, if mines keep struggling, if that distant nation keeps its silver at home, if the deficit deepens for yet another year, then the very thing that looked like weakness will reveal itself as a setup. And the person who sold into the panic will have sold at precisely the wrong moment, for precisely the wrong reason. That is the danger of a comfortable story. It does not feel like a risk. It feels like wisdom. It feels like safety. And that is exactly what makes it so expensive. The headlines were never lying. The central bank was real. The dollar was real. The crash was real. But it was only ever half of the truth. The loud half, the visible half, the half that required no thinking. The other half was buried in the mines, in the factories, in a quiet government rule on the far side of the world, silent, patient, and far more powerful than the noise that drowned it out. The market believed it had seen the whole story. It had only seen the part that was easy to see. And in the end, that is the one mistake that costs the most.